Ready to get started. Thank you all for joining and welcome to this Coalition Greenwich webinar, European Swaps Trading Market Structure Update. I'm Kevin McPartland. I'm the head of research for our market structure and technology team here at Coalition Greenwich, and I will be your moderator today. Just a couple of admin points before we get started. Questions are definitely welcome. Please use the question and answer box in the system. You can enter those throughout. We'll try to take them as they come. If not, we'll save some for the end, but please don't hesitate to do that. We love questions. If you have additional questions after the webinar, we can provide contact information, so don't hesitate even then to follow up. After the event, you'll be asked to participate in a very brief survey just to let you know what you like. Let us know what you like, what you didn't like. We do very much take a look at those, so if you can take that 30 seconds, we'd appreciate it. And then lastly, we are recording the webinar today, so we will send a link around and post that after the fact, so keep an eye out for that. Or if you have any colleagues you want to share with, then obviously please do. And so with that behind us, we have a great panel today. I'm really excited to sort of dig into this market and see where we are, how the market's evolved post-COVID, what's happening with electronic trading, and what we expect to see from here. So with that, if I can ask everybody to just quickly introduce yourselves. From my screen, Boz, why don't we start with you, and then we can sort of work around.
Yeah, thanks, Kevin, and happy to be here today. My name is Boz Nalbotla. I look after the European institutional rates here at TradeWeb. Yeah, so excited to talk about the market structure today.
Dan?
Yeah, thanks. Also happy to be here. My name is Dan Gotlander, and I run the Euro interest rate swap trading at Citigroup.
Great.
Yeah, thanks, Kevin. I'm Jasper. I work at Achmea Investment Management, and there I'm a senior portfolio manager of LDI.
Fantastic, great. Well, thanks for being here. So obviously a perfectly crafted panel, trading venue, sell side, buy side, so we really can get a feel for the whole market. Dan, why don't we start with you? We'll start very high level. The COVID market, at least the market part of COVID is behind us. The shock is behind us. Can you talk a little bit about what the state of things are today? You know, market liquidity, sort of any obvious things that have changed, and then we'll go from there.
Sure, sounds good. Happy to start with that. Look, you're right. I mean, COVID was a tumultuous time for all of us, you know, both personally and in the financial markets. And you know, the market has been much healthier since then. I think you know, we've had some interesting moves in the market in dollar rates and euro rates, sterling rates, you know, across the board this year. It's a very interesting start to the year with a more dull summer, and now this fall autumn here, you know, I think we've seen activity pick up a little bit more. So, you know, we classify the market as a healthy market. You know, things on people's mind obviously is potential action from the Federal Reserve and the BOE, and even, you know, what's going to happen with the ECB. But look, overall, you know, it's a good market. Some things left to figure out when it comes to Brexit and clearinghouses and things like that. You know, we're awaiting clarity on that, you know, later this year. But I would say it's a healthy market with plenty of liquidity.
Great, Jasper, from your seat as a liquidity taker, how do things look?
I think I agree with that. I think it was pretty stressful the first few months when all the lockdown started, and that was very when we saw charges blow up, and it was very difficult to get things done. After that, it stabilized, and I think especially after summer, it's been liquidity as usual. So I think yeah, that's very nice how it recovered actually. So no complaint there.
That's great. It talks to market resilience. And Boz, obviously, you're a big part of the market infrastructure at TradeWeb. What was your experience?
Yeah, I think, you know, we're entering kind of the new normal now. Obviously, you know, like Dan and Jasper said, liquidity there in the peak of the March volatility last year. You know, we observed bid offers in European swaps around 2.5 basis points on the 5-year and 10-year point. Now we're back to kind of normal, very liquid markets, half basis point wide. So yeah, things are getting back to normal. You know, Dan referenced Brexit, that where everyone has changed a little bit. We have traders, you know, in different cities. Obviously, a lot in Paris nowadays. But then also from a trading perspective, a lot of the sell side is back in the office. Buy side, you know, there's kind of a really more of a variety depending on the type of institution. So.
That's great. And then just to follow on some of those comments, Dan, you mentioned about central banks. Obviously, the Libor transition is very front and center around the world. Any immediate or expected impacts from central bank activity or the Libor transition?
Yeah, short answer, yes. In the euro market, the Libor transition itself has been slightly less impactful since we haven't really traded euro Libor for quite some time, and it has been possible to trade it, but it's more of a pre-EMU instrument. Now, the main instrument in the euro market obviously is Euribor, which has been certified. There's no immediate plans of retiring it. What we have instead is the Ionia to Ester transition going through. Obviously, Ionia has been Ester plus 8.5 basis points in spot or the fixes for quite some time. So it's been a relatively orderly process when it comes to the market impact, but it's an operationally intense process with between banks and bilateral counterparties, between everyone, buy side, sell side, and clearinghouses. Coming mid-October is when we'll see the clearinghouses restrike a lot, change a lot of these contracts, actually unwinding it and putting on new trades. Those to remove Ionia and replace them with Ester. So I think that has really been the biggest thing for us going through. And central banks, just to quickly touch upon, central bank action, this has been dominating the markets pre-COVID a bit too, obviously, but definitely post-COVID with quantitative easing across the board in the euro market is no difference. I think no different. What we're going to be looking out for here now is what's going to happen as that PEP comes to an end potentially, and any potential increases in APP that's going to come out of the ECB. But the central bank the ECB still has a big presence in the euro market.
Yeah, it's something that won't change. Jasper, the Libor and everything around it, obviously a lot of work for the banks. Is that taking time away from your day-to-day?
Yeah, that's true. For us, it's also a lot of work, mainly on the bilateral trading positions we still have. It basically introduces another risk, right? So cleared swaps are discounted versus Ester, while your bilateral only changes when you agree to it. So you basically have two curves to look out to, and it makes it more complex. Obviously, for us, that's something we can manage, but explaining it to end clients is an extra step. So and it involves a lot of discussions about, for instance, if you use bonds as collateral, where to value that. I think every bank in the street has a different opinion on that, and from our position, we need to find some kind of common ground or some own vision on that, even though we don't really trade these underlying repo products. So it's a complicated situation, and I think on the bank side it's much more operationally and also with loans and stuff they need to do. But for us, it's a lot of taking a stance and explaining it to clients. So it's especially in the position we are in, it takes us a lot of time as well.
Yeah, and then Bas, I assume for you, there's a lot of operational changes, data changes, the workflow, right, related to Libor?
Yeah, exactly. In terms of the Libor transition at Tradeweb, we've engaged with our client base, both on the dealer side and the buy side, to discuss kind of the transition, the operational changes required. It's about 100 days left till the end of the year. We've seen very good progress on sterling Libor transition. We see 90% of the risk last month traded against Sonia, the Libor replacement in sterling. So that's in a very good spot. Yen and Swiss, the other two Libor currencies that end at the end of this year, we've also seen significant traction, but those conversations are still undergoing. And in the dollar market, there's been significant progress on the dealer side with the initiatives from regulators such as SOFR First. But on the client side, it's still kind of an ongoing conversation as they evaluate liquidity. So it's got a lot of work, but at least we're close to the finish line on 3 of the 4 currencies being affected.
That's great. So good progress. Still taking time, but good progress. So with that, Bas, we'll stay with you. Why don't we jump into electronic trading? I think that's where we want to spend a lot of our time today. Why don't you give us a state of the world there as well? Obviously, there was the first sort of pushes from sort of post-financial crisis that made a lot of change. We all know that. What about the last 2 years, sort of leading into COVID, and then now in this, post that big change, sort of, where are we? What has changed?
Yeah. I think, in the last few years, and especially with kind of the COVID impact, electronic trading seems to be more of an integrated part of the majority of the market's workflow. I think that's led by a bunch of different reasons. Initially regulation kind of kickstarted things in Europe with MiFID II and the different categories of clients being subject to trading venue obligations. But more recently, the workflow benefits, the price transparency benefits have caused a significant shift in behavior towards electronic trading. In terms of the marketplace where we see kind of the dealer to customer market, we think around 40% of flows in terms of risk get traded electronically. So I think that adoption continues, and the collaboration between TradeWeb and both the buy side and sell side, and helping progress that traction is what's getting us to this point.
Sure. And Dan, so what about you? I know your team has had to be in the office most of the time. Any changes, COVID related or not, just in terms of workflow efficiency?
I mean, I'm not really sure if it's COVID related or not, but we always, want to increase efficiency, increase our capabilities on the e-trading side. So like Boss said, we have a close relationship with providers such as TradeWeb and our clients, and trying to align, what do clients want, what is possible on the TradeWeb side, what development is required on our side to support that. And, it's sometimes a little bit of a lead time. So that communication and they do kind of joint interest in moving forward with these things is something that's continue ongoing. And maybe a little bit, a lot of these things got a bit of a boost due to COVID. Maybe realized, okay, we need to step this up a little bit quicker. But I also like to say I think it's probably something that we've been trying to do for some time, and we'll continue to do for a very long time. So yeah, it's exciting. It's exciting to see the new products come out and how clients and dealers interact. And sometimes, like I think the list tool is a good example of maybe when it was first, this is many years ago now coming out, it was not maybe envisioned to be more of a compression neutral thing. And I see a lot of risk getting traded through it. So I mean, I think it's cool to see how market participants use development, and not always in the way that maybe you intended, but obviously turned out to be great.
And Jasper, what about from your perspective? What's working? What's changed, if anything?
I think the use of platforms like Bas already described, MiFID has been a big push. Also the move to clearing, more standardized products. So the platform helps with that. And then, of course, the next step is for an organization as ours to integrate it in our system so that we have straight-through processing, less operational risk. And that has helped a lot during COVID when people are trading from home, which is, of course, in a dealing room situation, there's always been checks and balances, subconsciously people checking and talking about trades. But if you're all alone in a room doing these trades, then I think it's very nice that the system basically does a lot of checks for you. So I think we've used it a lot, and I think the developments there, like Dan mentioned, the lists and these kind of things. Yeah, it's mainly for compression. I think we use it for that, but you can also just use it to do outright trades and just connect it to your own system and make everything as smooth as possible. So that in case you need to work from home and you don't really have many people checking certain things, you still know that everything is at least straight through, so you don't have any risks in losing out there. And then I think the only difficulty is what we saw in basically when lockdown started. So in March 2020. If liquidity drops, then most platforms go blank as well. So then you had to dust off your phone to find out where liquidity was. So I think we always keep a tab on the old ways of trading to find out liquidity and do some market discovery as well. I think you're basically shutting off your chat system and your phone and just using platforms exclusively is still very difficult, especially in difficult market circumstances. So I think it's going to be going forward. It's going to be a hybrid situation. You use the best things out of the platforms, but you don't throw away all the good things that you have from having a dialogue with your counterparties.
Right. Well, and it's so to that point, it's still very much relationships still matter quite a bit, right? So what impact has the e-trading growth had on that relationship, that dealer-client relationship? Has it enhanced it, or has it just changed, but perhaps still better?
Yeah, I think it's changed. It's changed a lot because there was always this point of contact between us and a bank about doing a trade. So you had this conversation and you did some deals. But now it's mainly salespeople come to you after you did a trade because they saw it on the platform. But I think spreads have become even tighter on platforms. So it's just about who wants to show you liquidity. And if you have no relationship, you're not going to get shown liquidity. I think that's a little bit how it works. And it will be fine if the market is very liquid and everything works. But as soon as it gets more difficult, then of course you need to have relationships in order to execute your trade. So I think it's more an effort from our side as well to make sure these relationships are maintained rather than just basically using the platform as only way of communicating. But on the other hand, it made also opened up opportunities to connect to more counterparties because in the old days you need a lot of documentation, which nowadays with MiFID and EMIR, it's all the platform takes care of that basically. So I think it has improved in some ways, but it's also been in some other ways has been become a little bit more effort from our side. So.
And Dan, so I'd be curious. So what do those post-trade calls look like? Is that, hey, how did it go? Everything good for you? What else can we do to help? Right. I'm just sort of curious how that conversation goes and how that relationship has evolved.
Yeah, no, I think, I mean, from the bank side or the dealer side, you want to see if the client is interested to do more, what else can we do to help? I mean, kind of general relationship. I mean, I think the relationship still is extremely important. Like Jasper said, I mean, it's just changed a bit, maybe how we interact. But you take a holistic approach to how you interact with clients. You look at voice trades, electronic trades, everything else, funding or what have you. And I mean, from the relationship and profitability of clients will drive dealer decisions, as with clients, relationships and execution, quality and spreads from it will dictate who they trade with and all these things. So, I mean, the e-trading doesn't change any of these things really. Definitely, it doesn't hurt these things, but if anything, it makes it easier potentially to track data from the dealer side. Okay, well, what are market impacts after people trade and all these things. I mean, it's even easier to keep track of these things. So I think it's shifted a bit on how you track everything, but to be honest, the overall relationship and the management, like you say, hey, picking up the phone or chat or whatever, like, what do you need? Thanks for the trade. What else can we do for you? And all these things. I mean, that's still there, and it's probably not going anywhere.
Yeah. And Boz, yeah, from your side, I guess I have two questions for you in this regard. So one, presumably there are some new things on the platform or platforms in general that help maintain that relationship. So curious sort of what you guys are doing there. And then separately, the other important part of this conversation is you as the venue, obviously now the relationship you have with the liquidity makers and takers is also very important. So would be curious to understand how that has evolved over time.
Yeah. No, definitely, Kevin. I think in terms of how we help in terms of the relationship and how we can kind of play a role there is definitely, in some ways kind of increasing the distribution. Jasper mentioned the fact that, once you trade on venue, there's less paperwork needed. There's a cleared aspect to it, which simplifies things. And also the data aspect that Dan mentioned, like that's such a key thing that both the buy side and sell side track, and for different for different reasons, but that's been a huge additive part of the conversation. And as we roll out new protocols, the data associated with that, whether it's RFM or two-way markets, things like that, that really plays into the conversations we've been having with clients. And in terms of how our relationship with the respective sides of the market plays into it as a trading venue, I think a way that we've been able to help is for both sides. There are certain initiatives or trades, trade types that in some cases the sell side want to electronify, and in some cases it's the buy side that wants to electronify it, and we help kind of put that together, and we work with both sides on that. So for example, using the buy side, for example, when they have certain things that they need to do, like transition from a Libor to an RFR in a certain currency, or gain liquidity in emerging markets in request for market, for example. That's something that we have a conversation with the buy side that's active in those certain protocols, and they will then kind of have conversations with the dealers directly around the need to increase liquidity in that. So there's there's a lot of conversation on both sides on that part.
Great, great. Yeah, relationships are still important. I think that's the message here for sure. So we mentioned a little bit about some of the regulations. What role, if any, do regulators or regulations have in the continued growth of e-trading at this point? Are we sort of over that, and from here on out it's organic, or is there still a big role based on sort of newer existing regulations to drive more e-trading? Really, whoever wants to jump in there.
Yeah, I'll take a stab at that. On the regulation side, the kind of the big regulatory steps that drove price transparency and kind of e-trading was really, that's happened via whether it's Dodd-Frank in the US or MiFID II here. A lot of that's kind of done. There will be tweaks to that. There's currently some consultations with both the Bank of England and in Europe with ESMA around the changes in how trading obligations will apply with new Libor replacements. So there is some of that, but I think the majority of growth is from here is more organic in terms of clients deciding whether there's certain types of trades that they want to electronify. But we also see one other aspect to it, which is that there are kind of regulation that sits in other aspects like the uncleared margin rules, which Jasper mentioned that helps bring more trades to clearing. Once a trade's cleared, it's much more easy to trade on a venue given the standardization. So that's kind of how I see that playing out on the reg side.
Yeah, I agree. I think there's still some stuff that's not cleared, and if it's not cleared, it doesn't really happen on the platform. But that's being pushed out by a new regulation. Obviously, people on our side, we have started trading cleared swaps only recently from the buy side perspective. So a lot of things like compression is still very new, because if you start trading, you don't need to compress because there's nothing to compress. But if you start building a portfolio, at some point you have so many trades, you start to look at these kind of things as well. So that's still in development. And there are of course new features like asset swaps, where you do bonds and swaps in one trade. First you start with your normal trades to use platforms, but at some point you have this one type of trade you still need to do voice. You're thinking like, can we also not do that on the platform? And I think the platform's already developing that. So there's still some room left, I think, to grow and adding new products. Talking about swaptions and stuff like that. If you're used to trading everything on the platform, or everything's possible on the platform, at one time a month you need to trade something that's voice, you think like, this is annoying. Can we not move these platforms as well? So there will be a continued push of new products going there. That's a little bit how it works. And I think it might go slow, and then you can maybe say it's not regulation that's driving it, but obviously initially it always comes from that perspective with MiFID and EMIR and basically standardizing it, and everything else following behind it.
Yeah, Dan,
I don't have too much to add. Yeah, I mean, I agree with Boss and Jasper, and I think the regulatory impact has been huge. It's obvious we know it, but now the drive to improve, and be it best X, and what have you from the buy side and everything else. It's a continuation of the regulatory initiative amongst market participants. So we'll continue to see it develop, but at least there's no immediate regulatory push. Other than what Boss mentioned.
Yeah. Other incentives, if you will, if not explicit new regulations. Jasper, you've touched on this a bit already, but can you maybe talk us through how you decide when to go electronic, or versus when you do feel like you need to start sending chats or pick up the phone?
It depends a bit on the size. I think small tickets, you don't really need to do anything else in using the platform. That's an easy one. You can leave the whole voice part out. But in the end, like I said before, like all the systems and all the booking is connected to the platform, so you can never go around it. So you always need it. And of course, there are features to pre-agree a trade and book it through a platform to get the booking. So I think that's the two extremes. And it really depends on the situation, on the market conditions, and how it works. And I think I think we try to avoid to put too many counterparties in competition. I think it doesn't really helps your liquidity to put like all your counterparties, all 20 of them, on the same trade, especially if it's sizable. But we do base that on counterparty rankings, on people showing access. So you still use the old-fashioned ways of executing. So I think So I think that's a little bit how it is. And I think if you look at small rebalancing flow, especially in more cash products, I think that's almost fully automated. You don't really have to. It comes from your system into the system. It selects the dealers automatically, and you can execute it almost automatically. And you almost go into almost algo trading with these kind of things. And I think that's still something that's a bit far away for us, but it's slowly moving in that direction. I think that's just very convenient, because these kind of trades obviously take a lot of time every month or every week, depending on how often you need to do that. But it doesn't really add much or decreases the risk much. It's not really changing your portfolio. It's just like maintenance. And obviously there's a big push from every organization to keep these kind of maintenance trades take as little time as possible. So.
And Dan, what about you? Like sales, trading, probably different but similar motivations to Jasper in terms of when somebody thinks, hey, we should call the client directly.
Yeah, I mean, in the end, we do we'll try to accommodate what the client wants. From my goal is to show basically the same pricing, be it voice or electronic. So that's right. I mean, like I think there are a lot of efficiencies with electronic trading. There still makes sense to pick up the phone sometimes, or like Jasper mentioned, maybe reduce the number of comp depending on the size of the ticket. Like I don't think the main thing is really voice versus electronic. It's just how you control the information, and I think some people are more comfortable controlling the information and by phone or chat for now, at least. But I think it can be done with electronic trades too. It's just how you do it. So I think that's the key. But in the end, for me as a market maker and for us as a firm and everything, we're really just trying to be in tune with our clients and do what they want. I don't price differently, etc. Like it's not about voice versus electronic.
Right, and you bring up about information, which is a good segue into the data conversation. So Jasper, do you actively measure execution quality in general? Do you compare E versus voice in some cases? And then I assume there's more data available now, which allows you to do some more things in that regard, right?
Yeah, I think that's always been something we did also with the voice trade, just to keep track of who you trade with and who shows good liquidity, who doesn't. But it's all manual. Yeah? You have the spreadsheet where you fill out this information, and if you're busy, you forget it, and then you delete the row for it's all very manual. But now with platforms, everything is just downloadable, so everything from timing to everything. So it makes it much more convenient to do these kind of checks. And obviously, going back to the regulator point, of course, the regulator wants to know transaction costs for pension funds, for instance, in the Netherlands. So we need to show that to our end clients how much transaction cost has been. Obviously, you can keep track of that in voice trade as well. You have some estimation of what it should be, but now it's all in the system, and you just have to define the metric yourself, and you just download it, and you have everything available, and it just makes it much more convenient to have this kind of information ready. So I think it's always been there, but now it just takes much less time to collect it and to use it efficiently. So.
Yeah, I mean, in bonds, we think of your role, TradeWeb, right? It's a trading venue, but really in the end, right, you're just as much about sort of data aggregation and provision and all of that, right, as trading now. Would you agree with that?
Yeah, no, I definitely agree with that. On the data side, obviously there's a lot that we capture. I mean, at one level, it's client sends out a request for quote or request for market, and we log all the quotes from the dealers, and they can use that for best ex purposes and tracking purposes. And then we have the market data side where clients are consuming that market data, and whether that's to set up alerts on their side or to automate execution, the market data and the need for market data in fixed income and especially interest rate swaps. The conversations around that just continue to accelerate. The market data obviously in some other asset classes is even is a bigger portion of execution. So we've made a lot of investments in that area. So I think the data piece continues to dominate a lot of our client conversations.
And then Dan, I assume you guys are both doing an analysis on your own trading, but then also are you providing data to your clients about execution quality? Is that part of the process?
Yes, we do look at our own quality, and in terms of providing data, yeah, I mean we're transparent. We have this platform called City Velocity where we have a lot of data available for clients. So it's a bit of a matter of definition in terms of what exactly we provide in terms of execution and execution quality and getting done at certain spreads from mids or levels. Matters differently to different clients, but look, we are open. We have to discuss markets and execution strategies and everything with our clients, and that's something that we do every day. I mean, it's something we consider a part of our, the core of our offering, if you will.
And if I throw this out to all three of you, is there any place where you feel like data in this market is still lacking, right? Something that you want that you don't have access to today?
I mean, I think we can use something that is stands out massively is kind of post-trade reporting, right, under MiFID II versus say Dodd-Frank, and then the difference in looking at executed trades versus say the SDR. I mean, I think it's a very, very big difference there, and I mean, we could say that data is lacking in terms of easily identify trades after they've been done and what prices, etc. On a relatively quick basis.
Yeah, I agree. I think things like market depth, like what's being traded, these overviews that are around, like I've never seen any trades I did in there, so I don't know. I don't know how much percentage it captures, but there's a lot of information lacking. Obviously, it's I think difficult to collect everything, but yeah, that would also be very useful to us to see a little bit, like if you do some trades, what percentage of the market are you, and to get a better estimate in when you can execute what size, and then what needs to happen for you to be market moving. It's still mainly guessing from our end, and obviously after years of doing that, you have some kind of idea and feel of the market. But yeah, in the current environment and this day and age, we would like to see some more data on that as well. But we'll see.
Yeah. Buzz, anything new you guys are working on in that regard, or just as a data projects in general?
On the data side, we continue to kind of expand what we have on our TCA offerings. I think the thing with swaps, which is very different than a lot of the other products that we have that offering for, is that a lot of what trades on our platform is not, there's no stream price associated with it, because clients are matching dates versus certain assets, or it's a hedge fund that's trading a certain forward swap where there's not necessarily a screen price. We do have indications on kind of where we model that price to be, but that's only a reflection of our own pricing. I think one thing that we've seen recently is when we introduced RFM, which is the ability for a client to get a two-way price back as opposed to disclosing their side. The fact that in addition to kind of where we say either our composite mid is or our model mid is, they can overlay kind of actionable two-way markets that were quoted back from the banks. So that's a way that clients have been using data more in a new way, I would say, recently. So yeah.
So that's a great segue, actually, Buzz. So can you talk a little bit about, and then we'll sort of go over to Dan and Jasper, what protocols sort of beyond the traditional RFQ are growing? I know we talked a little bit about list trades. You just mentioned RFM, but sort of what's been the progress with some of the other non-traditional RFQ protocols?
Yeah, I think I'll focus on those two. Request for market, having that ability to get the two-way quotes back actually exists for what clients can send on a regular outright swap, or for what we have on our list and PV trading. So when a client wants a two-way price on a portfolio of swaps. So both of those have seen significant growth, and part of that, there's I think two parts to that. One is that dealer liquidity in these protocols is now very robust. The majority of the dealers that price euro, sterling, and dollar swaps can quote two-way markets on both portfolios and outrights. So that's gotten to a critical mass over the last year. So that's why we've seen significant client take up. And actually, in certain currencies like the emerging market, we see more RFM business than we do RFQ. So that's been growing significantly. People want to minimize their footprint, so that's on the RFM side. And on the list side, it's Dan referenced it before. Various use cases used to be just for netting down of positions, but it's grown to bespoke strategies of swaps. It's grown to being used for migrating from one clearinghouse to the other. Brexit-related moves, and also the Libor transition. So clients taking existing Libor positions and migrating them to their new indices. So those are the two kind of protocols that have seen significant growth over the last couple of years.
That's interesting about RFM in emerging markets. Dan, are you seeing similar with some of those protocols or any others?
Yeah, sure. No, yeah, I think those are the two main ones, list and RFM, and I think the RFM, I like to add RFM, RFQ, or RFM on the list it's useful for everyone, because in the sense that the client can protect some of his information, and for the winning dealer, other dealers don't immediately know which side the client traded on the market. So I think these are welcomed kind of ways to execute, and we're seeing them grow more and more in Euro swaps, I should say. Yeah.
That's great. Jasper, have you you talked about lists? Have you dabbled in the request for market side?
Yeah, we did, but it's not as useful. It depends on the type of investor. I think for us, it's if in a larger program doing several similar type trades using both voice and platform, people know what you're doing. So yeah, if you're a hedge fund and you have some kind of idea of where market is going to be and you want to protect that information, obviously I can understand. I also understand emerging markets. If everybody knows in certain illiquid currencies where you are, that can hurt a lot. But yeah, if you need to do let's say 30 euro swaps in significant size for an insurance company or a pension fund, yeah, after a few trades, people know what direction you are, and then yeah, what are you protecting? So I think it's not as useful. I think it could be useful if it's for more tactical type of trade. So of course our main business is hedging, which is very directional. But if you are doing more tactical kind of trades, you do asset swaps, for instance, where you can basically trade both ways, because depending on the spread, these kind of things, it might be more useful. I think it's yeah. So for us, list is much more useful in both for compressing and all these kind of changes, backloading, swaps. So it's also a little bit of an operational tool, and using it also for yeah, just changing portfolios and then adding some delta as well at the same time. I think that's the tool we use much more often, and for RFM, it's nice it's there. I think you have the flexibility to use it, but I think the benefits are for our type of trades not as much as maybe for some other ones.
Yeah. Well, yeah, I mean, you've all done a really good job of laying out the idea that there isn't one trading mechanism to rule them all, right? There's lots of situations, investor types, firm types. And so what you need is a toolkit of a variety of these sort of protocols and technology offerings and data points. Right, given the situation. So that's good that increasingly seems to be available and pieces are being adopted. And so just one last item on that point. Do you feel like, it's maybe, I guess it could be for any of you really, has there been any progress towards bringing larger like block trades more electronic? Do you feel like the average trade sizes have gone up? Jasper, I think you mentioned that in the beginning, right, about sort of times when it would make sense to pick up the phone. Do you feel like you've seen any progress on the block trade side?
I think it's been fairly stable. I think it's been, yeah, when we started using platforms, it was very small, and then at some point people accepted larger sizes, and I think since COVID it's been pretty stable. So I think, but it's always a bit tricky, right? Because you can try to do a larger size, but if it doesn't work, you basically hurt yourself. So it's a difficult experiment to do. But I do think, especially if it's in shorter tenors, it's probably doesn't really matter anymore. And I think I was described, like rebalancing type of trades or end of month type of stuff. It doesn't really matter what you do. So I think size is possible. I think if you go, especially if you need to do more trades and more clips, it's yeah, basically it doesn't really matter whether you do it in one clip for large size and clip it up and use very short time in between, basically doing the same thing. So I think how to execute larger trades is still yeah, I think it doesn't really matter how much platform can handle or how much people are willing to quote on the platform. People will call you straight after what you're trying to do. Is this everything? And you still get the dialogue you might want to avoid. So maybe technically it's possible and you might get a good price, but you get in a lot of discussion, and maybe next time your liquidity providers will think twice about showing you liquidity because the way you're executing. So I think it's not as easy as it might be.
Sounds a bit like buying a car. It's technically possible to do it online, but often you still want to talk to somebody.
Exactly. I think that's a good analogy.
What about
I actually bought a car online. It was completely fine, I can tell you. So
there you go. See, it can work.
It can work. I tell you, the 7-day return, policy helped because I'd never seen the car. Then you get 7 days to look at it or whatever. No, but like I say, it's like what Jasper said. I don't think it really matters too much if it's voice or electronic. But the easy thing with electronic maybe is to say, hey, I put $60 in COP on these tickets. Now I'm going to do the same for this bigger clip or what have you, right? I mean, it's just controlling the information leakage and these things. I think you still need to go to dealers that you trust, on the buy side. But on the dealer side, I'm happy to show prices for big clips for clients that I trust, right? Electronically, I don't think it really, if it's someone that you don't trust, or maybe you think like, Jasper said, okay, they might go multiple clips, so the market moves against you, etc. I mean, I think the behavior is the same in terms of how you price it, be it voice or electronic. Now, all dealers might not be as fluid, maybe we're not even perfect at it ourselves, but the goal here is really to have consistent pricing for client speed, voice or electronic, and really it shouldn't really matter too much how you execute. It's more about the manner that you execute and how you control, who you're dealing with and stuff. So I think the trust there between, go back to what we talked about, the relationship and everything, it still matters a lot between the buy side and the sell side, no matter how you execute, because in the end, you're executing risk to someone who takes the risk on the other side, right? If it's voice or electronic, that doesn't go away. Sending an RFQ is not trading on a club or trading on, a future stack. Like you're calling someone saying, hey, I need you to take this risk from me, or you're clicking a button and sending an electronic message saying, hey, I need you to take this risk from me. It's the same thing in the end, right? It's just two different ways of doing the same thing.
Mm-hmm. Mm-hmm. And Boz, anything that you guys see in the data with regard to average trade sizes or any other changes?
Yeah, I think to expand on what Dan and Jasper said, I mean, what the large trades that we see on the platform, it's very customer dependent. It's very dependent on how that client has manages potentially relationships with their counterparties and the trust involved in that. I think from a data perspective, we have seen a significant increase. Like if we were to look back, at, data in 2017 versus data from last year, we saw a doubling in trades over 100,000 DV01, which is kind of a decent cutoff for a large trade. In the dollar market, we see trades, on a regular basis that are above 500,000 in DV01. Dollars is the most liquid, I would say, for large size. But it's that execution sits within kind of the holistic conversation between that buy side and their bank counterparties. So I think it's going to continue to grow, but within that framework.
Okay, great. So I think we're just about ready to wrap it up. Maybe we'll leave it with sort of the usual end of the panel question. Any good sort of nuggets of wisdom thinking through what's to come in the rest of the year, whether it be in the market, central bank activity, market structure, e-trading, anything that you're thinking or keeping an eye on that you want to leave with us in the audience? I don't know, Dan, maybe we'll put you on the spot first.
Sure. I mean, I think the in addition to everything we've spoken to, and I mentioned this a little bit earlier, but and Jasper talked about it too. I mean, I think the the moving away here now from bilateral trading onto clearing houses, and then also which clearing house, how does this play out, until the end of the year with LCH as Eurex, market standard versus another clearinghouse is very large, so there's a lot of futures trading on it, etc. I mean, I think that's gonna be something we're monitoring very closely. Like, how does that change market dynamics? Are we getting a situation where a certain type of client, say onshore, your continental clients, EU clients trade on one clearinghouse versus the rest, right? I mean, I think it's something we have to monitor closely. It's unclear where we're going to end up, and I think it could have quite large impact on liquidity depending on which direction we go.
Great, thanks, Dan. Jasper, any last words?
No, I think I completely agree with that. I think the Eurex LCH thing is going to be big till the end of the year, until there's some kind of agreement there. We spoke on this already, so I think that's something we also look at closely, and like we said before, list or any these kind of tools are very useful to do these kind of trades if needed. So
great, thanks so much. And Buzz, we'll end it with you.
Yeah. In terms of what Dan and Jasper said about kind of the Eurex LCH, that is a cliff event, or kind of an event that we're closely monitoring. In advance of that, we also have the completion of Libor transition in 3 currencies, and also the migration of dollar risk into SOFR by the end of the year. So we have a lot of that going on, which is keeping everybody busy on our side. But in addition, I think now that we're in this environment where we're hopefully coming out of COVID, and everyone's back at in their execution mode, whether it's in the office or at home, one thing that we continue to do is collaborate on with the clients on what are the trade types that you may want to electronify that aren't on the platform now. So continuing to have those conversations and giving people the optionality is something that we're always focused on.
Fantastic, great. So great. Thanks, Boz, Dan, Jasper. Really enjoyed the conversation. Really great insights. Thanks for all your candor and information. And for everyone, thanks again for taking the time. We will again send out a recording over the next couple of days. Please do stay on and take that quick survey. But again, thanks everybody for your time. Thanks to the panelists, and we'll be back. We'll be back again soon. Thanks so much.
Thank you. Thanks.
Thank you, Kevin. Thanks.
Thanks.